Hi guys, welcome to your first online video recording of an accounting lesson. Today we are going to start our work on inventory, which is chapters 7, 8 and 9 in your textbook, and you might know that there is a number of holiday work tasks devoted to chapter 7. I'm going to split chapter 7 content into 3 videos, all of which will cover this concept of the perpetual inventory system. This video is just going to be a real introduction, give you some key terms, explain the importance of inventory and recording. So then when we get into the accounting recording in the next 2 videos, you'll have some grounding to do this. So there will be no textbook exercise to do after this one, but it will be important to update your notes with your understanding from this video. You might be using the Cornell note system, which I've asked you to do this, and I'll give you a bit of a video on the next day or two on how to do this, and hopefully that'll really help with your note taking. What's our goal for this lesson? We want to be able to discuss the key features of the perpetual inventory system, and if we have a really successful lesson, if you could leave this video understanding what has been discussed, you should be able to, 1, define inventory. You should be able to outline the key features of this perpetual inventory system. You should be able to explain what is a physical stock take and what is involved. And then hopefully you can describe the use of what we call an inventory account. How are we going to run this video? I know it can be really confusing when a teacher explains something that's slightly different to the slide, so I will repeat what's on the slides, and then hopefully I'll give you a bit of insight, some tips and tricks on how to remember it, maybe a few examples. What is inventory? Maybe it's a really good place to start to say what is not inventory. We know that inventory is a current asset. That means it is not a non-current asset. What is inventory? It's all the goods we purchase as a trading business for the purpose of resale. What do I mean by resale? They're held purely for the purpose of reselling, for selling them at a profit in the normal course of business. So it can only be inventory if the business holds it to sell it. So they will have a number of assets that are current assets potentially, or just assets that they use on an everyday basis, shop fittings, equipment, computers, which aren't inventory because we're not selling them. What do I mean by perpetual? You might have heard that term in other subjects before. I mean it is a continuing, lasting forever. It is never ending. The sole purpose of a business is to buy inventory cheaply and sell it more expensively using a markup, which we know how to calculate now, for a profit. So it is continuing, for never ending, lasting forever, this concept of our inventory system, because it's what a business does every day it exists. Why is it important? Why do we have a whole subject? Why do we have 3 chapters of our textbook devoted to inventory? Simple answer, it's really, really, really important. It's probably the most significant asset the firm controls. It's definitely the most important one in terms of its profit because it's what it's selling to make profit, to make revenue. Inventory, as I just said, is its main source of revenue of a trading business and thus the key to its ability to earn profit. A firm that cannot sell stock will not survive. And while it's quite challenging out there at the moment due to the coronavirus, you can see a lot of businesses being concerned about stock. If they can't open, they can't sell their stock, they won't survive. It's also, while our most important asset, it's also one of our most vulnerable. It's susceptible to a lot of things. It is susceptible to being damaged, losing value, not being able to be sold, spoiling, and I'll use an example of that later, theft, and just purely changes in tastes or fashions. If we think about all 4 of these, if your inventory is impacted by one of these, you can't sell it for revenue. You can't sell it for a profit. And hence, it's a really important asset for us to understand, to manage and control, because we're using it to make a profit. If one of these four things happen, we might not make a profit. Because of its importance, because of its vulnerability, it is vital that we have a system that provides accurate information about stock. We need to know how much stock we have, the different type of stock we have, and how fast it's or slow it's moving. Then a good business, with the help of good accountants, can make really good decisions. You will see a number of terms in this chapter, in this topic, and it is important in your notes to have some definitions down. So when you see that term, you don't get confused, you know what we're talking about. I would encourage you to have these in your notes. And this will repeat a little bit. Perpetual inventory system is an accounting system where the inventory movements are recorded continually throughout the reporting period. Perpetual, never-ending, continual, and we know what inventory is. So we need to have a system. A perpetual inventory system is a system that records every time inventory moves out of our business and comes into our business. The inventory account records all movements of inventory in the general ledger. When you see the word account, you should always be thinking of a ledger account. What is inventory? We know it's an asset. We don't have a specific ledger account, as you know, for different types of inventory. So this is the total amount of inventory that is coming in and out of our business. It records all of it. That's great. It's really important to know, for example, that we have $25,000 worth of inventory in our business. But we need to know more than that. We need to also know how much we have of each individual item of inventory, because businesses don't just sell one piece of stock. They don't just sell desks, for example. They sell chairs, beds. If it's a furniture store, they sell lots of different things. So you'll now see an inventory card, which we will discuss in more detail in a later video. The inventory card is used to record the movement of each individual line of inventory. And if you have done Year 11 and remember Year 11, that is where we have our in and out columns recording individual items of stock. If you've been unsure about that, we will go through that in a later video. We use these inventory cards because they tell me each individual line of inventory to tell the balance of the inventory account. So the inventory card and inventory account are linked. The balance of the inventory account in the general ledger should equal the total of all the individual inventory cards. Really simple example, the furniture store that we just talked about, if it has $10,000 of desks, $5,000 of chairs, and $2,000 worth of beds, it will have 3 inventory cards. If we add all of those up, our inventory account should equal $15,000. 10 plus 5 plus 2. We have a system, but we still have another element of this because inventory is so important. We need to know how much we have at one time. To do this, we do what we call a physical stock take. You might have been a poor unfortunate employee who's had to do it at one stage. What is a physical stock take? An important thing to write down, you'll see questions on this. It involves physically going down the aisles and counting units of inventory on hand at a particular point in time. It must occur once every reporting period. So every business has to count every single item in their stores and their warehouses at least once every reporting period. It has 2 main purposes. We need to determine the actual value of the inventory to record in the balance sheet. We need to know actually how much we have. And we need to then check that the inventory recording process is working. If we use the example of the furniture store again, if we think we have 10 desks on our inventory card, all worth $1,000, so $10,000 worth of desks, but we go do a count and realize we actually have 8, that's an important information to note. We have less desks, we have less of an asset. Obviously, going and doing the counting is more accurate than just relying on our computer program or our inventory cards. There are 2 stages to this. You actually have to do the physical counting to work out how many we have. For example, we've done a count and we have 8 desks. And then we calculate, find the cost price of each unit. Remembering we value assets at the cost price, and we'll go into more on that later because it is verifiable. We have a source document. And we use this to calculate the total value recorded in the inventory sheets or inventory cards. If we do a count and we have 8 desks, and we know from a source document their cost price was $1,000 each, we now have an inventory card that would have $8,000, and we'll go into more inventory cards later. As we discussed, a physical stock date determines the value of inventory on hand on balance day. The balance day being the day that we make our reports. We typically do the stock take really close to the day we're making our reports. But why do we have a perpetual inventory system if we can just do a count at some stage? The perpetual inventory system allows us to continually update the balance of our inventory each time inventory moves in or out. We know we have to update our inventory when inventory is purchased or contributed by an owner. When we do that, we know that our inventory balance increases. We also know when inventory is sold, withdrawn by the owner due to drawings or donated as advertising, this will decrease our inventory balance. The perpetual inventory system records all of this, so we should have a pretty accurate idea of our inventory. Why use it? What are the advantages of it and what are the disadvantages? Really typical question that you'll see in a second exam. What are the benefits of always knowing and updating our records to know how much inventory we have on hand? What are some of the advantages? You might want to pause this video and actually have a think about it. If you haven't paused, or if you paused and now had a think, some of the advantages you might have come up with, or you might make notes now. It's really efficient. It makes for more efficient recording to do it when it actually happens. Gives you lots of control if you are updating your inventory for the ins and the outs. You have control, you know what's going on. It allows you to identify how quickly stock is moving, an important thing that I'll talk about later. It allows you to identify inventory losses, something we will talk about in a later video. It allows you to do profit reports quickly without doing a stock take. A bit more of a complicated one, which we'll briefly touch on. What are the disadvantages? Like my business management friends, perpetual inventory systems sound great. We should know how much inventory we have. We should be recording the ins and the outs as it happens. What are the disadvantages often in business of something that sounds good? It can be costly. It can be time consuming because of additional record keeping. And it doesn't replace the physical stock take. So you still have to go and do this count because that's actually the more accurate way to work out. But it's just a pain in the butt to do. In this slide, and I won't go through too much to make it a shorter video, you can update your notes. Here's a bit more information on each of those advantages and disadvantages. So if you see a question in your textbook, in a SAC, potentially in a practice exam, these are some stuff you could talk about. Now we move into the inventory account, and this might be a bit of revision. As we know, this inventory account is the ledger that records the movements of inventory coming in or out. We know that the balance of the inventory account represents the total cost of the inventory on hand. Why cost? Because it's what we recorded at cost price. We know that inventory is an asset. We are experts or becoming experts with our debits and credits using Paler. If an inventory goes up in our business, that means an asset has increased. An asset that increases, we know, is a debit. And we know that debit purely means left-hand side of the ledger. If inventory decreases, it is a credit. Assets going down are a credit. If we look at that table, increases in inventory are caused by lots of things. Inventory increases in our business if we buy inventory, if we have an inventory gain, which we'll talk about later, or if the business owner does a contribution of inventory. It contributes inventory to the business. Inventory can decrease for a number of reasons too. If we sell a good, that's great, that's our goal, but inventory will go down. And you remember that is our credit, and the debit in that transaction is cost of sales. We can have inventory loss. We can withdraw inventory via drawing, so the owner is taking inventory out. Or the inventory could be used for advertising. So if you see the word donation in a transaction, that means it is advertising. Because even though it's donated, it sounds like we're doing it out of the goodness of our heart. We will get a bit of benefit from it, hence an advertising expense. Some really common transactions. I'm not going to go through this so the video it doesn't get too long. There are really 4 transactions you'll see with inventory that are typical, and then there are some special ones. If we buy goods for cash, it could be inventory will go up. That will be our debit, there will be GST, and our credit cash will go down. You can see the debits and credits on the right-hand side. We could also buy inventory on credit. Very similar transaction. Inventory goes up, debit. GST is a debit because we've bought something, we have paid GST, we have less GST that we owe to the government. Hence our liability goes down. But we have an accounts payable liability here. Also, we can sell inventory for cash or credit. A really complicated but common transaction where there are 5 debits and credits, and we've become really good at that. If you are unsure, I would definitely pause this video and do a quick revision of these debits and credits. So guys, hopefully we can look back at this video, look back at your Cornell notes on your notes, and be able to tick off a number of success criteria. In this video, we have covered the definition of inventory. We have talked about the key features of a perpetual inventory system. It's continuous. It looks at inventory. We know the importance of inventory and it's also its vulnerabilities. We can explain what I mean by a stock take, the physical count of inventory to work out what the accurate amount is. And we can also describe what we mean by the inventory account. So this general ledger, we're starting to think about some debits and credits that are involved. In our next 2 videos, we will start to think about how we actually record in our inventory cards. That will be our next video. And then also what happens when we have a stock take and what is the impact of when there's a difference between our count and what we think we have in our inventory card. Guys, use this video. There is no textbook particular questions on this, but there will be aspects of this in all your textbook questions. I think it's a good time to pause, to update your notes. And so when we start to go through the actual transactions in our future video, you'll have a really good grounding of the understanding of inventory.